morning, members. Welcome to this video update for Friday, the 31st of July. As we've been doing lately, I'm just going to deal with the US market. It's about 3 hours into the Australian market open at the moment. So we've got a very strong day going in Australia, which is great to see. The volatility in both America and Australia is just awesome. We're getting plunges that look like the company's going out of business. And then overnight, we get reversals that are just absolutely blow your socks off when stocks like Microsoft are up 15%. And some of the picks and shovels stocks that I've been talking about lately in the US market are also gapping up by 12 to 15%. It's just diabolical volatility. Anyway, we'll do the best to pick our way through it. We kind of feel at the moment like a juggler with about 15 knives in the air because we've got lots of competing things that we're trying to achieve, or some of them are certainly complementary, but there are some things that we're trying to do to span the breadth of the membership that we've got. And the only way that we know that works to tackle this is to give you the very best education and ongoing perspective and teach you how to make decisions, because we can't put out recommendations that are suitable for everybody, not remotely. So to us, that is the smart answer. And to our knowledge, there's really just no one else out there that's doing it that way. They're doing it in all sorts of other ways that leave you short of what you really need. Teaching you how to do it and teaching you how to think and supporting that process is just light years ahead of any other approach to the market. Anyway, that's our view. There's the licensing information when it comes up. This is general advice only, of course. All right, let's jump in. So I'll just dive through a couple of charts very quickly that are just really important perspectives. Again, they're points of learning. I've spoken about this a few times. This is SpaceX, another couple of weeks on, and just always beware the hyped new listing. It's presented as it's an absolute no-brainer. Of course, you would have to buy into this listing. It's just, there's no question about it. The IPO price was 135. The opening price was 150 on the 12th of Jan. They raised $75 billion, and the current price, we've gone as high as 225. So we went from an IPO of 135 to 225, and now we're back to 112. And I said at the time that the history of these sort of listings are that you would be better off waiting a year. And this chart just supports what I've said. So if you want to get into the space race, which incorporates AI and just about anything else you can think of, and I think it really is a serious theme for the future, but it's long term. And the companies involved in this may not be producing the sort of returns that we're looking for a decade. So the time to consider this, I believe, is somewhere between 2027 and 2028. Even then, it may not be the right time, but I don't think you should be looking at getting into SpaceX anytime soon. So there's a lesson about the very hyped IPOs. This is the NASDAQ, and you look at the last two sessions, that one followed by that one. How can they possibly be driven by fundamentals? And the answer is they can't. Those price charts do not reflect a change in the fundamentals. And it just points to this erratic volatility that we've got. That means that you've got to have more clarity and more open-mindedness and more free thinking in your investment decisions. Keep it simple. I hope this isn't coming across as something that's onerous. It really is so very simple to get that clarity and to do things that are best for you. So that's the NASDAQ, all over the place. This is really an important chart as well. This is gold versus the S&P. We might be forming a base, but then we might not. It's an unconfirmed glimmer, and the way that stocks are trading, it doesn't give me really solid lead that we're on the cusp of a significant rising gold stocks. It's coming, but until I see it, this could go down further, could go sideways, so could the stock prices. Now, let's just look very, very quickly, because this is still, the semiconductor trade is still a industry group that's in a state of flux. And as much as some members out there want to tear into the semiconductor sector for whatever reasons, it's just not a high probability thing to do at the moment. Again, look at this volatility. Extraordinary. This is on DRAM. So how do you play it from here? Well, as I see it, and we sold out at 49, and last night it opened at 59, and last night it opened at 43. So had you stayed in DRAM, then you should have only done that if you had the full awareness that the stock could have fallen another 20% or 25%, which is what it did. And most psychologists can't deal with that all that well. So for me, the semiconductor trade is a watch at the moment. Same with MU. We sold out at 902. I talked about this in the alerts yesterday. And look at these two candles back today. How can that be driven by fundamentals? I mean, the fundamentals are just so ridiculously cheap that it defies any kind of logical thinking. But when you've got this sort of volatility, tell me what's going to happen tonight or next week. And if anyone can tell me, looking at that chart, what the next couple of sessions are going to look like, then I'll give you a lot of money. It's just so unpredictable. And when it's unpredictable, we don't have probability in our favour, so you may as well go to the casino. Just sit back and wait. Trends like this are fantastic. This is the almost straight 45-degree trend. They're just wonderful. You don't see that many of them in a year, but when you do, you grab them and you hang on to them. We got in at 40 back in January, and now we closed last night at almost 73. And there's been very little heart palpitations in that trend. Overnight, the US dollar gapped down, traded back up, and then finished low again, so we actually finished under 100. That should have fired commodities up, but looking at commodity stocks today, and in the US last night, they're just not firing the way that you would expect. Anyway, there is silver, so there's exhibit A. Not a lot happened there. Yes, it was a little stronger. There's gold. So for those that want to pile into gold, because they just want to, they've got an idea, a bias in their head, and they just feel that they have to get exposure to gold or they'll miss out. Well, look at that chart and tell me that that's any different to what it was 3 weeks ago, and that we've got an imminent sharp rise in our hands. And no one can, of course, so just wait. All right, this is Credo. Looks exactly the same as a lot of the other semiconductor stocks. Got smashed, just got caught up in the whole deleveraging thing, which hopefully we're getting towards the end of. We really had to put a stop loss on this because this could have gone all the way down here. I had no idea. It could have gone down to 100. So this was just risk management 101. If you try to guess this and figure out what's going to happen, is it going to fall a long way or is it not? You can't do it that way. You have to play probabilities, and the probabilities of this going down significantly further have risen a lot. So we do the sensible thing. We let the market take us out. We put a stop loss on half at a level that really shouldn't get broken, and we got stopped out. But the good news is we've still got half. And the long-term outlook for Credo still looks very good. This is CRH. It's just breached the stop loss, which has been there for a couple of months. So this is now, and it was so emphatic, and I don't know why, but it was so emphatic. We've been in it a long time. it's done nothing much. So we'll sell the remainder. We sold half much higher, I can't remember the price. But whatever amount that any members got, let's put a limit sell on that on the remainder at 95. Now, this is Vertiv, and I've now changed my view because of last night's response. So my argument on Thursday was to leave the limit sell at 265 where it was, in the hope that, well, not the hope, but the probability that the fundamentals were solid enough that the price would bounce back, like we've seen on many others. But the fact that it traded so poorly last night is not a good sign. So I think we need to be out of this. And I've switched it from a half sell to a full sell at 215. Now, the good news is that we've still got plenty of profit to work with, and I want to minimise that. So that's the other reason. So our average entry was around 134-ish, 135. We're getting out at 215, limit sell. Closed last night at 227. So hopefully the market is not negative tonight and we can get out at that level. All right, there's been some discussion around CLS, which we got out of fully. That was done on the 17th, which is here. Again, I wasn't happy about it, but at the time, I was getting peppered with questions from members about cash and exposure levels. And so, again, in the interest of trying to serve as wide a cross-section of the membership as I could, this looked a pretty dramatic and emphatic break of support, and so we exited the next day on the full position. Now, we then immediately bounced back again, and this is related. The reason I put this in here is this is just absolutely related to GNP, TEA, and SXE, which are causing some members a bit of angst at the moment. And it's just a reminder, and I'm not recommending that members go either way, but I point you back to what I've said a couple of times in the last week, and that is the very first thing you need to do. So I've elevated this to the number one consideration. The first thing that every member must do is rate themselves in terms of the three categories as I've defined them. The first one is you're really tolerant to volatility and you don't mind too much. You can turn a blind eye to the really good stocks unless there's a change in fundamentals. And so you do nothing. That's the first basket. The second basket is, or let me go to the third basket. The third basket is that you're not tolerant at all and you need to be taking profit off the table and getting out on more immediate weakness in the share price. So that's basket number 3. And then, of course, basket number 2 sits in the middle. So that's, everyone should have a sense of that. And there's no reason that everyone can't have a sense of which basket they fit in. And then I'm providing, through the alerts and through the videos, I'm providing my view of what the chart is doing. And from there, you take that perspective and you apply it to your situation. And I think that's as simple and straightforward as I can possibly make it. And if I don't happen to cover the situation that you're in at present, then you can always email me and ask for my perspective, not my opinion, because that's personal advice. But you can certainly ask for my perspective on how I'm seeing the charts unfold. Because we've proven over many years that the really good stocks, if you can deal with the 25, 30, 40% periodic drawdowns, then you can have 10 baggers, 20 baggers on your portfolio, which just makes you a year, almost makes you a decade if you get a few of them. So we want to try and stay in those stocks if we can. All right, that's CLS. Now let's move to SMH. It was a limit sell last night. It broke support the night before, Wednesday night, but fortunately it gapped up really strongly last night. So we got the opening price, which was 529.86. So we're down to a half a position on SMH, on semiconductors. And I think that's a positioning that I'm comfortable with because the long term for semiconductors still looks really good, but the short term, just way too unpredictable. And a lot of that is not because it's not a good trade to be in. The Amazon result overnight showed that Amazon was up 10%, and that it was more than that. It was just more than just the price reaction. It was the fundamentals and the company's outlook statement through to 2028 that was really good. So there's little doubt in my mind that the whole semiconductor food chain is going to be back, but I just don't know the time frame, and I don't know how much more downside there might be in it. So it's important to register that point. So the end point in a year, 2 years, 3 years, whatever it is, still looks really, really rosy, but some members won't be able to comfortably negotiate it, and that's fine. That's as it is. Just make sure that you've categorized yourself into the appropriate basket. All right, this is AGX. Unfortunately, we got stopped out. Yeah, so we actually sold out half on a gap down. So we've held half, we got out at 520, but the other half last night closed at 580. So we're still in the game, and it was a good volume spike there as well. All right, now, as I mentioned in the alerts yesterday, we're not turning our back on AI at all. We're moving to the sidelines on parts of AI that are less predictable in the short term. So our probabilities have gone down. So we're not shoving them to the side. We just watch and wait. But in the meantime, because I know that certainly most members would have a degree of cash and might be looking, so we don't need to wait for the AI trade to set up again. We can go into other areas. And those other areas have become higher probability because of this rotation that's happening in the US market from tech into other areas like healthcare, like the picks and shovels providers in the data center build out, also some finance, and there's also a couple of steel stocks that are looking really good. So the process we're going through there, while some of these are not in the megatrend area, it doesn't mean that we don't follow the same process. And the same process is we first of all establish on a fundamental basis that we're in the right fishing hole. So that stock has got the fundamental merit to pay off in the way that we want it to, and that is more than 20% a year with a high degree of probability of being achieved. So that gets us in the right fishing hole. And then we then revert to the charts for entry points. So this one is really interesting. This is VEEV, which was mentioned yesterday, 34 billion market cap, cloud-based software for the life sciences industry, so not for the technology industry as such. It's founder-led, which obviously I love, recurring revenue, which I love, high margins, which I love, net cash, which I love, and they're deeply embedded in an industry that is growing very, very strongly. And they're in a position where they can zig or zag depending on how this whole AI food chain thing plays out. Now, the one thing that does create some uncertainty, and it's probably why the price dropped through here, is that they've, severed their relationship with Salesforce CRM. So they're a business in transition. So they've got to execute that without damaging retention of customers or the economics of customers' businesses. But the chart is impressive. The financials are impressive. Look at the revenue line. 1.85 billion back in 2022. We're now looking at just over 4 billion projected by 28. Earnings, 263, really started to pick up into next year, 906, 10 to 3. Return on equities are building nicely, so we're almost up to 20. And the PE ratios have come down a lot from almost 100 down to the mid-50s, 38 this year, then 23, then 21. So I'm quite comfortable with all those. So this now becomes a formal recommendation by the first portion, around $200. It closed last night at 201.56. This looks good. We've formed a base, and we're just coming out of the base. We broke out on Wednesday night. It wasn't a particularly emphatic breakout, only just popped its head above the breakout, and there wasn't really any significant increase in volume. So a bit of a mild breakout, but it's not in a sector that is copying the volatility. So there's a bit of an advantage. And if you ask me to compare the risk-reward around this at this point in time, then I think this is a bit more attractive than the AI or semiconductor trade, because it's been sold off, and it's only emerging from that big broad range in the last couple of days. So there's no big profit-taking overhang here. That means the risk to the downside is much, much less than a semiconductor trade or AI trade. We've also got the support of the money flows. We've now got a higher high up here and a higher low. So from a technical point of view, it stacks up pretty well. So that's one for tonight. But look, in this diversification, which encompasses healthcare, it encompasses steel, it encompasses financial stocks, mortgage brokers. I've got about 20 stocks on that list. So there is lots coming. We remain all over the AI trade. So that's not getting ignored. There's lots of things coming, but we're only going to recommend them when we think members can do well out of them, that the potential upside justifies the downside risk. I'll just whiz through these quickly because they're not formal recommendations. This is TWR. This is Picks and Shovels, company around data centers and the electricity grid. The closest to one, if you wanted to say, well, what is this equivalent to in Australia, are SXE and GNP. That's what how this business lines up. So they're an $84 billion infrastructure company for electric and gas utilities, power generation, manufacturing, communications, energy, etc. So this is a lot less volatile and a lot less risky than the AI trade, but they're directly benefiting from the AI trade, the power demand. High voltage transmission, expansion, the renewable grid integration, and also utility CapEx cycles are really strong at the moment. They're not cheap, trading around the low 20s and 27, but we have had some selling, some sharp selling, but then we got a huge gap up last night on earnings. So that is certainly one under strong consideration. Having had a huge gap last night and then some selling coming out up here, I don't want to recommend it at this stage. I want to see another session or two. And this is another interesting one. This is WEX, market cap $6.5 billion, fleet payment solutions, billing inquiries, all those sort of things. It's niche, network, high margins, strong cash generation. They've got aggressive buybacks and they're at quite a low forward multiple. As you can see here, they're trading on PE multiples in the single digits. Now, this year, the year-on-year earnings is expected to be 24% higher. So single-digit PEs are attractive. Now, the 5% growth into FY27 and 13%, to what extent are they just conservative analyst numbers? I've got to do a little bit more homework on. Also, too, this has just rocketed up from 125 to nearly 190. So I'd be looking for some pullback, but that's a very strong chart with lots of volume. So important, we just need members to understand we're all over a lot of things at the moment. Some excellent opportunities are going to arise out of them, but we really do need the proof that it's sustainable. Welcome back, members. The Australian market closed around about 40 minutes ago, so I've got my charts loaded and ready to go. Just a couple of charts that I omitted to show this morning. These are some of the other US stocks that I'm completing research on that are showing really, really promising chart patterns, and they're across the various other sectors that I've been looking at. So this is Regeneron Pharmaceuticals, which is a massive global company in the multi-hundreds of billions of dollars market cap. This is a weekly chart. It's a pretty good looking chart. It's been a good week. We've now got a higher low, and looking very much like a higher high is coming. So a little bit more work to do on that, but that one certainly is looking pretty good. This is in the steel sector. This is the Indian global steel major, ArcelorMittal, and this is a daily chart, but also showing some pretty good promise. It's an existing pretty good trend, but a little bit unstable a couple of times in the last 4 or 5 months. But overall, you can see there's really a strong trend upwards there because it's not getting anywhere near pulling back to the 200-day moving average. In the finance sector, this is Fidelity National. That also looks pretty good, just starting to make a breakout. IESC is another picks and shovels company along the same lines as GNP and TEA, and also Modine Manufacturing similarly. So there are a couple that I'm keen to complete the research on. Now let's move into the Australian stocks today and what they did. This is 40X, and we finally got a bit of a bounce on some volume, but we need to do more than this. But hopefully this $3 support level is going to hold. Certainly that puts a little bit of space in the transaction for us. Right, this is CWM, which reported their fourth quarter results and also provided some guidance for FY27. So we've got a first core position up to 1350, and we haven't taken the second position yet because gold stocks are just not flavour of the month. And you can see even today, and this was pretty much across the board with gold producers, they gapped up on enthusiasm from last night in the US, and then they just sagged, and most of them finished slightly in the red. So there's just nothing doing there at the moment. And if we look at the numbers are really impressive. So there's the progression in earnings from 23 through to 27. Year on year, we're looking at some pretty robust values. 15% year on year into 2027 is not unusual because there's so much negativity around the sector at the moment. And the PE ratios also are really quite modest. So the market is pricing in FY27 to PE of 15, and that is good enough for the forecast. But I think that forecast will prove to be a bit on the negative side, and we're going to get better results than that. So I think this is one to definitely keep on the radar. So if we look at their results, they hit all FY26 targets, and they are pretty much our most productive and low-cost gold producers. And the low-cost thing, because you recall that most of our producers now are between about 2,600 and about 3,200 all-in sustaining costs. These guys are at 1,648, so that is really low. FY27 production is expected at 142,000 ounces at an all-in sustaining cost, a little bit higher, around about 2,000, but most of their peers are now above 3,000, so that gives them a heck of an edge. They're anticipating spending about 80 million on commissioning new plants and some other expansions. Free cash flow was at a margin of 42.6%. That is a very large margin. No wonder they're printing cash. And they've got $500 million in cash and no debt, which puts them in a wonderful position to do a number of things with their balance sheet. Just DUR, it's been sold off sharply the last few days, as has happened for these kind of stocks around the world. From what I can gather, there seems to be just nervousness about a number of things. It's the availability and cost of labour. It's inflation on the cost side. It's all the things that you would expect. And my feeling, which is not worth a hell of a lot because feelings aren't worth a hell of a lot, but my feeling is that this is the market jumping at shadows because it's been such a tough period for commodity stocks. DVP got absolutely smashed on Wednesday. Couldn't understand why. There were a couple of things that have impacted it, but certainly it steadied yesterday and then had a little bit of a bounce today. We've got a stop loss at $4.50 on half. We didn't breach that on a closing basis, and we closed today at $4.84, so we're still in the game with DVP. All right, this is GNP, and I want to take you through an exercise because there's been plenty of discussion with questions from members about this, and it really gets to the heart of how you manage your portfolio. So with your permission, I'll just spend a few more minutes on this. So we've currently got a stop loss at 780. And one of the comments I got from members was that if we put a stop up here somewhere, that it would have given members that are a little bit nervous, they're not in the totally tolerant basket, but they're in the middle of the road basket, an opportunity to decide if they wanted to get out, and that a stop loss way down at $7.80 was giving back too much profit. And I get that. But everything we do in the market is a balance. It's a compromise. It's a trade-off. You want to leave yourself exposed to the upside. And I'll give you a sense of what this upside could be to reduce this to a reward for risk way to think about it. Now, I've said many times, and I'm absolutely 100% convinced that if you were to somehow be able to switch off and just leave these really good businesses alone for 2 or 3 years, that you'll be ecstatic about your return. The difficulty with that, of course, is what happens in the middle, the way that it tests our psychology. Now, for a start, up until really yesterday, there wasn't anything terribly negative. Sorry, not yesterday, Wednesday. There wasn't anything terribly negative. Let me just put that, let me get rid of these last couple of days. So at that point, you might have argued that we could have said, well, this could be breaking down, but buyers stepped up here at the end of the day. So it's, and there wasn't much volume either. Volume was here. So that was a really big call, particularly for a stock that you want to let run. It's in the basket of, we want to let this thing run for as far as it can because it has a high probability of offering us a very good return. So for me, it wasn't until Wednesday when the market did that, that you could have contemplated putting a stop on this. Now, if I put a stop here, let's say at $8.10, then high chances are we get stopped out immediately. And that is not what we want with these kind of stocks. It just isn't. We want to try and stay in there. That's just one session. Now, since then, of course, we steadied. Yesterday, we closed up, and it was not an emphatic reversal candle, but it wasn't bad. And then we followed through today with a 5% jump in price. Now, let me give you a sense of risk and reward. So the forecast PE for this stock for FY27, so that's the year we're in now, so this is current PE. It's not looking 2 years out into the future. Current PE forecast is 24 times. Now, when you look at the year-on-year growth rates in earnings, they've been 90% year-on-year, then 40% into FY26, and then 33% into FY27 is the forecast. So even if we're able to hold somewhere around about 30, and I think that will prove to be too conservative, so the starting point in terms of valuation is not excessive. I think 24 times for this sort of year-on-year growth is absolutely fair, even with all the risks out there about inflation and labour and all those sort of things. So therefore, if we've got a high probability that this stock can hold its multiple, its 24 multiple, or somewhere in that area, then it means that the price should rise with the growth in earnings. I hope everyone is following this. So we're not having the share price go up because the multiple is expanding. It's going from 24 to, let's say, 35. That's not happening. It's just staying nice and steady, and price is just moving ahead with the earnings growth, and our starting point is fair. So therefore, if we can hold that sort of 30% growth rate, and we look at where it's coming into FY28, then the price moves from $8.50. So $8.50 is where we were. Sorry, I put this in the wrong place. So for me, the likely upside in 2 years is $14.10. So the stop loss was set low because we didn't want to get stopped out by the noise. That's the premise. So the downside from where we were yesterday to the stop loss was 54 cents. But the likely upside in 2 years was $5.60. So our upside was 10 times our likely downside to the stop loss. So is that kind of gelling? This is how I think about it. I look at it from a risk and reward and probability point of view always. So I look at that and say, well, I don't have a problem with risking another 54 cents because realistically in a couple of years, I could be $6 better off. So if you need to replay this bit of the video, again, then do so. But this is the absolute crux of what we talk about constantly. All right, moving on. LRV hasn't really broken down. It's been holding its ground pretty well. Volumes are really, really small, and we're moving up through the commissioning processes. So I think as soon as commodities get a more general bid, that we'll see some pretty good stuff from LRV. Pilbara Mines, we've got a first position at 643, which proved to be, that was when the real momentum was building, proved to be a pretty poor entry. But it's only half. The long term for lithium still looks pretty robust. We've got a stop loss at $3.60. And again, the same exercise I just did with GNP applies. Yes, there was a bit of a gap down there, but it's only half a position. It's not a full position. And hopefully we get the opportunity to add the second half of that at quite a low price. Now let's finish off with the last two that are very similar to GNP, and I could go through the same exercise. So SXE has got a stop loss on half at $3.60, which is quite way down. But the same argument applies, and the same with TEA, with a stop loss at $7.35. So hopefully everyone, it's really starting to gel about this process that I spoke about in the first half of this video, which is the very first thing that you must do is just know who you are as an investor. Which basket of risk tolerance or volatility tolerance do you put yourself in? You must know that. So that's it. I'll be back with you on Sunday for the public video, and also next Tuesday for Taking Stock. And Taking Stock will be obviously very heavily focused on learning. There'll be plenty of things to get our teeth into there. So that's it. Have a great weekend, everybody, and I'll be back with you next week. Cheers.